I think the financial markets are forecasting that the Fed, not just the Fed, but all central banks, ECB, Bank of England, Bank of Japan, well, Bank of Japan, they've been doing it forever. They're going to have to loosen policy. And we've seen that bond yields have come off substantially in the last month. And that helps gold because real returns on bonds are going to come down relative when you take account of inflation. The reason why I think the dollar and the euro and the yen and the pound are falling versus gold is that governments are still borrowing and spending massively.
The gold prices notched a new record on Monday for a second day in a row, with spot prices touching $2,100 as the global rush for bullion appears set to continue. Gold gains momentum as markets continue to price in a potential interest rate cut as early as March. According to the CME FedWatch Tool, markets are now pricing in more than 50% odds of a rate cut in the first quarter of 2024. Famous analyst Mario Innecco perceives a breakout in gold, referencing a pattern emerging since 2020, reminiscent of one from 2011, resembling a teacup. This potential breakout is attributed to central banks, especially the Fed, tightening policies after a prolonged period of historically low interest rates and quantitative easing. This unexpected tightening, alongside rising CPI, Consumer Price Index, sometimes misconstrued as inflation, and geopolitical tensions, led to gold prices stalling below $2,000, hovering around $1,800. Gold prices have risen for 2 consecutive months, buoyed by the Israel-Palestinian conflict, boosting demand for this safe haven asset. Expectations of interest rate cuts have further supported its value. Gold typically performs well during economic and geopolitical uncertainty periods due to its reliability as a store of value. Fiat currencies can be printed limitlessly in the current monetary system, causing decreased value and inflation. Gold has significantly outperformed fiat currencies over the past 2 decades, making it a preferred asset. Central banks increasingly hold gold due to its stability against currency devaluation. A recent survey by the World Gold Council reveals that 24% of all central banks plan to augment their gold reserves in the next 12 months, reflecting growing skepticism about the US dollar as a reserve asset. Mario views gold as an obstacle for central bankers and powerful individuals as it curtails their control over currency values. Gold safeguards against inflation, protecting people's hard-earned money from losing value due to currency devaluation. We will present clips from Mario Innecco, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Why do I think gold is breaking out now? We've had, since 2020, we formed a top. We formed this handle in the huge teacup that started in 2011, and even the handle looks like a teacup itself. Well, I think it's been because of the Fed and other central banks finally tightening policy after a couple of decades of very low interest rates, negative real interest rates, a lot of QE. So they stopped that, and then they started tightening, and they've tightened more than most people imagined. Even me, I didn't think they'd get that much above 2 or 3%. But the thing is that the CPI, which is what people call erroneously, not in my opinion, but it is erroneous to call CPI inflation. That was taking off. It wasn't transitory as they thought. And then you had other things helping prices higher, like geopolitical crises, which I won't go over here. And that's why gold, I think, stopped, under 2000. It kind of held around 1800. Yes, we dropped to even above 1600 in the meantime. But what's happening now is I think the financial markets are forecasting that the Fed, not just the Fed, but all central banks, ECB, Bank of England, Bank of Japan, well, Bank of Japan, they've been doing it forever. They're going to have to loosen policy. And we've seen that bond yields have come off substantially in the last month, and that helps gold because real returns on bonds are going to come down relative when you take account of inflation. And I think a lot of investors don't buy these CPI numbers. A lot of people hopefully are learning about what real inflation is. There's no exception to the rule that all fiat currencies end up being worth zero. Just like Voltaire said, paper money reverts to its intrinsic value always, and that's zero. But the tough part about holding gold and silver in a fiat currency system is the psychological war that the central bankers and the bankers wage, because I think it was Paul Volcker actually once said in a meeting with someone, I heard this years ago, I'm not sure I can find it online, but he said that gold is the enemy of the central bankers. And he's right. And gold is also the enemy of the state and statists, because fiat currency allows them to steal your hard-earned efforts, your labor, your ideas, your production, because they can inflate that currency away. They get the currency first, you get it last. Well, gold protects you against inflation, against theft of your efforts. Of course, confiscation is a different story.
Since 2020, there has been a notable and persistent rise in U.S. inflation. This upward trajectory saw inflation levels hitting approximately 6.8% by November 2021, reaching a 40-year peak of 9.1% in June 2022. Mario observes a significant inflationary trend from early 2020 onwards, acknowledging a slight downturn at a later point, but emphasizing that current inflation rates remain substantially elevated compared to previous periods. He doubts the effectiveness of present measures to counter inflation, such as recent discussions about raising rates by institutions like JP, deeming them inadequate. Mario relies on indicators like M2, encompassing M1, and some short-term deposits, to illustrate that while the increase isn't as substantial as M1, it still notably surpasses pre-2020 levels. This distinction underscores the persistence of increased monetary supply beyond the immediate measures, signaling a continued impact on the economy. Moreover, Mario holds the view that currency devaluation is likely to continue. Even if governing bodies attempt to manipulate bond yields downward to control economic factors, gold retains its status as an unwavering benchmark for determining the true value of a currency. Let's get back to the interview.
So, as you can see, we've had massive inflation since January 2020 or March 2020. Yes, it has deflated, but it's still way above here. And I don't think they can deflate anymore, even though Jay Powell yesterday said, oh, we will raise rates again. But I don't think they're doing enough. If they were doing enough, gold would not be making new highs. So M2, of course, includes M1 plus some short-term deposits. Unfortunately, the Fed doesn't publish M3 anymore, but it's the same story. It hasn't really increased as much as M1, I guess, but it's still way above where we were there before March 2020. As you can see, there's a little gray line there marking a recession. Yeah, it looks like it's flattening out right now. Let's look at it in 1 year terms. Yeah, as you can see, they started, it's flattening out right now. And as you can see, I've put here a chart of the NASDAQ composite. And you can see how important it is. Let's shorten the time frame. You can see how important it is. Like here, for example, when the NASDAQ was falling quite sharply, they started ramping up the money supply, right? And I think they're going to do it again. I mean, this is only till October, this NASDAQ chart, so it's come back up. So that's the other reason I think the markets are doing what they're doing, because the markets, of course, are addicted to credit, to easy money. And in a fiat currency system, you got to keep expanding the debt. You got to keep borrowing, or else everything collapses. And the other thing about the reason why I think the dollar and the euro and the yen and the pound are falling versus gold is that governments are still borrowing and spending massively, especially in the US, but also here in the UK, even in Germany. And that's inflation itself, all the fiscal spending. And people are realizing that with interest rates not really being in a good place. And what do I mean by that? Well, I think the bull market in bonds is finished. Yes, we have had a rally, but I think that's the other thing that gold is telling us, that to expect more currency debasement. And yes, they might be able to manipulate bonds lower, like bond yields lower and prices higher, like they've done in Japan. But ultimately, gold will tell the truth, just like it's told the truth of the yen. After all, JGB yields are really low, but the currency there is becoming, trashier and trashier by the day. And you just saw the chart of the price of gold in Japanese yen.
Analysts said that gold prices are on course to hit fresh highs next year and could remain above $2,000 level, citing geopolitical uncertainty, a likely weaker U.S. dollar, and possible interest rate cuts. Given recent trends, what role might gold play in reshaping currency dynamics? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.